Hey, and we're live. It is 6:40 Eastern Time on Easter Sunday. Happy Easter, everyone. Welcome to Benny and the Squirrel, another unmissable Sunday show. Hey, Ben, futures open. I mean, we've got another weekend escalation by the looks of things. Some of these crazy house tweets coming out of the White House doesn't bode for a great start for the week.
No, I don't think so. I saw, and look, it's always tough with this new Twitter of like what's misinformation, what's real, and then how much time do you want to spend double checking it. But like I did see a headline that I sent you that there was some decel plants in Kuwait get hit. I saw a fighter jet from the US went down. There was a few other things. It didn't seem like it was going more chill, that's for sure. And
yeah, it's certainly not going in the right direction, in my view.
It's weird because Wednesday night Trump pulls this, April Fool's joke on. I mean, that's not what he really did, but that's kind of how I took it. And market rightly sold because he said, "Hey, this is how long World War I was. This is how long World War II was." And you don't reference the length of other wars unless you're trying to preface your own or prepare your own people for a war, and that it's not going to be as long as those wars, right? Like, and so I think the right take is it's gonna keep going. It's gonna go longer, and people, especially the market. But then weirdly on Thursday they ripped the stocks, and I don't know what the hell that was about. And whatever, it doesn't matter. They've basically given back all that they rallied, more or less. I didn't see the exact.
So week on week into the close on Thursday, the SPOs are up 348 basis points. This doesn't make a great deal of sense for me. I mean, everyone is paranoid about missing a Liberation Day style rally in risk assets. I'm really happy to miss out, to be honest.
Well, we've had a couple of them, right? We've had last week, not this previous week, the week before that. We wake up on Monday morning and you get a 250 point candle, right? You go 6,500 to 6,750, quickly faded. Then Thursday we get another tweet that takes us from 50 or 6,500 ish, same level, to 66 and change, and that got faded quick. Then we sold, and then you had this rally, which I still don't really understand what happened on Thursday, and so they're fading, and like I don't know, if you're thinking about machine learning, are these algos going to soon enough learn like, hey, this, like, it's not working like it was, and everybody's trying to run this. Hey, there's a right tail, there's right tail convexity on a grind down left market, right? So we slowly go down, but then it will back like rip higher. And you're right. I do think that a lot of people are sitting there, don't want to miss it. But it's just weird when you're in a situation where the global energy and supply chain is so challenged. And I know that the oil market is telling you this will be taken care of, right? When you look at like December 2026 oil futures are up 12% since this started. So now they could be wrong. And you could right now make a bet there.
I know because I own them.
You didn't think of your oil position on Strait of Hormuz closing for a month was only going to get you 12%, huh?
So listen, we did a first this weekend. We did a Benny and the Squirrel written collaboration, and we took a dive into the SpaceX IPO. Now, neither you or I have an intention of buying a single share in that deal, if it even comes to market. But it's also something that you just cannot ignore because it's such a massive capital markets event, and the displacement effect for finding a home for 115 yards of stock is massive from a risk asset perspective.
Wow.
I mean, so listen, you and I are no strangers to the IPO market, but this really doesn't. This deal does not really have a precedent. I mean, I think we went through God,
Yeah,
it
let's
was over
start
a
there.
month
Let's
ago.
start there with a couple of the mega IPOs before we go into the
Well, no,
details.
we did that a month ago. People can go look back when your first show from Dubai with missiles raining was the one where we talked about the letter that I'd written to the Nasdaq and also putting it in the context. But you know, the green shoe on the SpaceX IPO is bigger than the General Motors re-IPO in 2010, right? Just put that in your pipe and smoke it.
Yeah, because we're thinking. So if we believe Elon at 2 trillion, so that means 100 billion afloat, right? Then the shoe is usually 15%.
Yeah.
So I'm looking at the list right now of the largest ever, and that would put the shoe at the 10th largest IPO in history.
Yeah,
the
shoe. I'm
shoe.
saying bigger than the General Motors re-IPO post the GFC.
It's just right around there. I have it at 15.8, but whatever. It'd be right.
Whatever.
Yeah. I mean, it's a staggering number. Let's put it that way.
Well, listen, we live in a world of large numbers, right? And the really important thing to learn is that we've become immune to. I remember when I first started in the industry, a $50 million IPO was a big deal, right? It's a big deal. It's a good payday for a banker, right? But we've all been, and my first employer went bust with a £400 million hole in its balance sheet. That was Barings in February of 1995, right? But since we zerpified the world and numbers just went up, right? It's important not to forget that most of these large numbers in the world are just ledger changes, right? They are digital entries that change over, $1 trillion of QE there or whatever, an operation twist there. When you place an IPO, you have got to replace that risk asset, right? If you're putting that risk asset into portfolios, another risk asset has got to go out, right? And we'll get to this, and we'll go through the numbers in a second. But let's start with the valuation of SpaceX. Now, it was back in. I mean, this is an eye test, and you can read it. You can read it on my note, and see this part of it's even in the free part of the note. But I first wrote about SpaceX's valuation when I was writing about the topic of space generally in October of 2024, and at the time, SpaceX was being valued in the private markets at about $200 billion, right? And that crazy man, Adam Jonas at Morgan Stanley, was putting out wildly bullish reports saying that the space economy, or the revenue total addressable market for the space economy in 2040 was going to be $1 trillion, right? So I went, okay, let's slap a multiple on that. And I think that was an overly aggressive example. I took the semiconductor sector as a EV to sales number as a multiple to slap on it, and then I discounted that back to today or then at 11% whack, right? And then I said, okay, on that basis, the private market was saying that SpaceX was worth about 20%. SpaceX had about a 20% market share of the present value of that space economy. I said that's probably too low. They've got 70% of the satellites in the sky, and actually, the market promptly sort of revalued Tesla up to a higher market share, if you like, of the space economy. But right now, you've got, just in the private markets, let alone Elon's, price talk for the IPO, you've got SpaceX being valued at 1.2 trillion, so at a 20% premium to the total value of the space economy, right? So what is SpaceX right now, right? You've got a very successful satellite broadband business, of which you're about to become a customer. But this is like it. Yeah, exactly. This is a business that we've known how to value for years, right? It's number of subs.
Yeah, because think about it.
Times ARPU,
right, you go ahead, and then I'll come on it.
It's number of subs times ARPU, right? And then there might be a direct to sell, which is the Starlink mobile business. But this is a business that you can model, and we've done it. We've modeled it. Okay, what do you want to say about Starlink?
No, that's what I'm saying. It's not like it's so revolutionary. I mean, I was involved with SiriusXM after the GFC when it was an incredible buy, and that was good business. You know, like, I mean, Dish. I'm friends with Charlie Ergen's son, and you know, got that Dish TV. You know, we've had satellite businesses before. This is not the first time. You know what I mean? It's not like it's like some new, you know, unseen business model.
Okay. Yep, good. So then we've got the launch business, right? And that's an easy business to value as well. It's launches on behalf of third parties, i.e., not Starlink related, right? Times a cost per mission, right? And you know what? You can run various scenarios, but it's very easy to model, right? And you pretty quickly run into natural capacity limitations. And then you've got XAI, which is the mashup of Twitter, Grok, and Jazz Hands space data centers, right? And this is the narrative rocket fuel, forgive the pun, which is the MacGuffin that stops everybody focusing on, you know, ARPU and external launch numbers, because you pretty soon run out of imagination to get numbers very big at that point in time, right? So that leaves you so I mean, we ran these models, right? This is so let's also not forget that yes, Starlink's growth has been impressive in the last 4 years, right? They're up to, you know, 10.5 million subs. They'll probably be, you know, 50% higher at the end of this year. But if you look top left, SpaceX's revenue growth is actually decelerating. So our modeling is looking at hockey stick, even in our conservative base cases, is looking at you know, pretty hockey stick growth numbers between now and the end of the decade, starting from a look back where growth at the top line has actually been decelerating. So, you know, before I get, you know, pounded on for being overly conservative about the about the modeling, you know, bear that in mind. So, you know, again, this is going to be a bit of an eye test on a phone, but the, you know, we put out 3 cases, right? The Benny and the Squirrel case, right, which is seeing Starlink compound top line at 10% between now and the end of the decade, launch revenue compounding at about 12, with cash flow from that launch, you know, compounding, free cash flow compounding at 66% CAGR, right? I mean, that's not exactly growth rates for ants, is it? Right?
No,
right? So,
no, good Zoolander reference there, buddy.
On that basis, right? Even on that basis, I put a number of a discounted cash flow number on Starlink of about $153 billion, right? The launch business, even at that growth rates, right, only worth about 17 yards, right? And then I've taken the XAI $225 billion valuation, which is the number from the merger. I've just taken it at face value, right? And we'll go in and talk about our imaginary debate with Gavin Baker in a second, right? So, the bull case, yeah, go on.
No, I was going to talk about the bull case for a second. I think it's like, you know, we can talk about all these numbers, and you guys, it's a little bit probably hard on the eyes, but like, let's put it this way. Like, I think $1 trillion for the XAI part of it is a very aggressive valuation. But if you gave him $1 trillion there and you gave him $1 trillion for Starlink, you're at 2. The launch services is just a rounding error business. You know, maybe one day they'll find gold on an asteroid and that will become its crown jewel. But until then, you're at $2 trillion. He's talking about $2 trillion as the valuation now. Yeah, it is asymmetric to the downside, because I think Rupert's point here is that you try to put on your mid-curve, like, reasonable hat, right? Reasonable assumption hat, and you come out at like $500 billion to $1 trillion. You know, it's a real business. There's value here. There's no question. But $2 trillion, yeah, it's going to be tough. It's going to be tough to make money from that level.
It's nuts. It's nuts. Then we debated Gavin, which was fun, right? So, you know, I know he was a former colleague of yours at Fidelity,
Good
but
guy.
he really
Good guy. Gavin's a good guy.
He's really become, Silicon Valley's sort of market cheerleader, right? And he was the first to come out and say, I'm going to get in front of this narrative. I'm going to get in front of this space data center narrative and never fade Elon. He's done it before with much harder problems. And listen, I won't take you through neither of us are physicists, right? And I don't want to argue the toss about vacuum cooling at scale, right? Frankly. And so, but we went through the exercise of just comparing, the two sides of the argument, bull and bear on the space data center business. And the funny thing is that in itself is a complete distraction. And it's quite funny. I was having Easter lunch yesterday with my brother-in-law, who builds data centers for Jeff Bezos at AWS, right? And I sort of broached him on the topic of the space data centers, and he just rolled his eyeballs and said, frankly, we're more worried about our data centers being blown up in the Gulf at the moment. But this is clearly not a topic of discussion in AWS, where the founder also owns a rocket business, right? So and has Amazon Leo, right?
And I think, it's funny because when we first were writing the report and I had the AI council kind of just like go through it, and I was sending that around to a couple guys, say, what do you think of this? The guy's like, well, you can't have a serious report unless you talk about AI data centers. I was like, oh my God. And we had Tom on the show and we talked about that a bit back in January, who, Tom trades power. He's an engineer. And, it doesn't matter. I mean, just look at the numbers. Like, it just doesn't matter.
Yeah, so the true punchline is, if you take Gavin absolutely at his word, right, that this thing's going to happen, the business is not worth very much relative to a $2 trillion gap. If you take Gavin's base case that it all works, right, and you value that 500 megawatt data center up in the sky, the digital sky daddy, as Chase Taylor likes to call them, that's $24 billion enterprise value, right? Okay, at a 20% whack, which some people take objection to. Okay, use 12. That's 35. It doesn't move the needle, right? So the whole MacGuffin, the whole jazz hands, the whole pixie dust around this $2 trillion ask doesn't really bear scrutiny. Now, I remember this when I was at the car company, right? The whole, if you like, the whole pixie dust around the electric vehicle revolution in 2018, 2019, 2020 was all about autonomous driving, right? Because unless you were talking about autonomous driving, everyone would start going unit, contribution margin, number, capacity. Oh my God, they start using widget maths on you. And then you can never get the growth capital that you need, right? And so this is AV, space data centers are to SpaceX what autonomous driving was to Tesla back in the day, and to any of the other Chinese car company startups that were doing the same thing back then. And the great thing about autonomous driving is that you could, now I don't believe this maths, you could talk about a global addressable market for mobility, right? And give robo-taxis a market share on that. The trouble is, space data centers are still unit of output times a number, right? You've got a physical asset that you need to value. So I don't think it works as a MacGuffin, right? But let's be clear.
You say that, but then let's talk about Tesla, because he MacGuffin guys consistently over and over. We still don't have damn robo-taxis. I mean, when the hell are we supposed to have FSD and robo-taxi? I mean, it just, how the Cybertruck.
I'll tell you why. This is where Silicon Valley broke the equity market, right? Tesla came out as a concept valuation car company IPO, but at a reasonable scale, right? Now, I have no doubt, and let's be clear, Elon Musk is, the best stock promoter that ever existed. And this time with SpaceX, he's got a web of insiders that were part of the 30 rounds of capital raising that SpaceX has done in the last 15 plus years, right? And let's not forget, only $12 billion of equity capital has gone into this $2 trillion business.
Yeah. When we were looking at the raise, I mean, we're looking at all the raises. I mean, Elon 20 years ago or 24 years ago, when he got paid on PayPal, did three things. He bought Tesla. He invested 100 million Tesla, 100 million SpaceX, and he bought himself $1 million McLaren F1 that he didn't insure and then wrecked it within a week. That's a true story, by the way.
I remember.
And look, 12 billion of raised capital, 2 trillion valuation. I mean, how can we not figure out how to do this, Rupert? We should get in the business of trying to sell paper like this guy. He's unbelievable.
The irony is that I did spend 25 years in stock promotion.
That's right. You're a stock promoter. You're actually a stock promoter. That's true.
No, but my point is that he's got an army of cheerleaders behind him, right? Wall Street is looking at a fee pool for this IPO of probably between $500 and $700 million, right?
Which is a big one.
Which is a big one. You've then got all of these guys sitting on SpaceX stock with microscopic basis, right? $2 trillion is $841 a share, right? Most of these guys' basis is sub 100, right? If not sub 50, right? So, don't expect any candor from Wall Street or from Silicon Valley. They're all in on this. So close your eyes and close your ears. Now, this is where it comes to the hard part, right? And this is why I want to circle back to why I think that the Silicon Valley broke the IPO market by fermenting all of these unicorns in private markets with La La Land valuations, with headline valuations, but funded with preference shares, and ignore statements that, OpenAI just raised 122 yards at an $850 billion valuation. That did not mean that Sam Altman's savings account at Silicon Valley Bank is about to get a delivery of 122 yards at some point next week. All of that money is, one, coming in the form of cumulative preference shares with guaranteed returns. Two, the funding comes with stage payments linked to KPIs, one of which I think Amazon's KPI is, involves, producing AGI, right? That funding is not a market displacement event. An IPO is, right? Ultimately, if you've got to do a 5% IPO of SpaceX at a true $2 trillion valuation, you have got to find a home for $115 billion of stock on one day in June, right? Now, he's already persuaded the index committees to bend the rules such that he can gather, up to a $40 billion passive bid. But, and then you throw the closet benchmarkers on the, active managers that are basically passive funds in disguise. You throw that on top, you're still $47 billion short, right? Who's going to buy that? Everyone already owns it. The sovereign wealth funds, right? Pretty much every sovereign wealth fund's at least been shown the deal multiple times at a lower valuation, or in the case of most of the Gulf sovereigns and the Singaporean sovereigns, already own it. There are ways in which accredited investors have been able to buy SpaceX shares on notice for ages, right? You've actually got a share price chart, right? And then even the Robin Hood crowd have got plenty of vehicles, whether it's Cathy Wood's ETFs or mutual funds or Barron's mutual funds, or the Scottish Mortgage Trust, the Baillie Gifford entity. And, even there are public companies like EchoStar, right? The old owner of the owner of the old dish, right? They have they've got a 2% stake in SpaceX, right? So there are plenty of proxies around. So who shows up for that $47 billion? And assuming you can get to that number, what does the aftermarket look like? I mean, I think you're going to saturate all possible demand for that deal.
Well, the aftermarket thing, I'm not as worried about because of the options guys. They'll get those options up and running fast, and so the true answer is it's leverage, right? It's leverage. It's like, hey, we're going to sell into the S&P, we're going to sell into the QQQ, we're going to sell into the option dealers. It's just it will be, but it's a lot of leverage. It's a lot of securities leverage.
That's a scary game of hot potatoes. So let's say you're a Midtown Manhattan hedge fund manager, right? Your trade is, well, I'm going to buy at $840 and I'm going to sell it to Vanguard at 1,000 in 2 weeks' time. And you, Goldman Sachs, Morgan Stanley, my primes, are going to give me the leverage, right, to do that. I'm not.
That's
sure
what it is, though. That's the answer. The answer is that. That's why they're changing the index rules, because they need to induce guys to buy this to then, float it. And then they'll be with the idea that then the index guys will take it off their hands. And then, then it's out in the ether, basically.
But we've just proven that that you're still short, right? So where does that come from? And also, let's assume, listen, I'm not fading Elon Musk as a stock promoter. Maybe he has a plan of how he's going to do it. But let's talk about the displacement, right? Because people go, what are you so worried about? $115 billion is, less than a day's volume of the top 10 stocks in the NASDAQ, right? But looking at average daily volume is not a measure of true executable liquidity. It's just not. This is all, Jane Street and Citadel's machines kicking stock backwards and forwards. It's Citadel's option market makers. The real liquidity doesn't go home at night, right? It is all intraday. And so ultimately, $115 billion of real liquidity needs to be raised when, average NASDAQ top of book liquidity is about 25 million, right? So what I'm saying in a nutshell is that I'm not sure that the S&P 500 can support $115 billion of net selling, right? On, with a view to being fully funded on a single day in June. Right?
Yeah, I mean, another way to think about it is like there's about $900 billion of buybacks annually, and this would eat up 11% of that, right? And remember, we've talked about it on the show numerous times. It's always about supply and demand, and they don't teach you in the CFA program and the MBA program. Like they just equity analysts, they model cash flows. They do very limited thinking about the supply side, other than if it's on an idiosyncratic basis. But yeah, it's a lot of paper. So yeah, let's go talk about history.
Yeah. Let's do that, because there's one thing for certain: what big landmark IPOs are a sign of, and what's that, Benny?
The tops. Because you know why? Just think about it from a very simplistic standpoint. You have a cycle. The guys who have the paper on whatever it is, they need a sufficient amount of excitement and hype, and that's when you dump it on them. Because you're like, hey, we're going to talk about Rivian in a second, but that's the best one. It was like clean energy and EVs, and when you have the most excitement for it, that's when you sell. Just by definition, this is kind of how it works. And I remember sitting in this meeting. We were one of the few firms that had a 2-hour meeting, and Schwartzman came in and gave his pitch, and it was the first private equity private equity company to go public. Sorry, that's a little bit of a mouthful. And just look at that. I lined it up against the bank index, the BKX. That's like right there at the top, and then that was it. Like, you know what I mean? Isn't that crazy? And then since then, I trimmed this just to show what was going on then versus. But then let's go to the next one. We have a couple of these.
So this is a deal that I worked on, right?
Okay, so you talk about this one.
So this is the IPO of Glencore in 2011, which was literally, the ding dong top of the China stimulus-led commodity bull market, right? And it literally, it couldn't be more perfectly timed. And I think, well, right now, Glencore is my single largest single stock position. Absolutely love it. One of the big reasons that I was interested in it again last year was Ivan Glasenberg, the former CEO, retired but still largest stockholder, bought stock in Glencore for the first time in 8 years last April after Liberation Day. And I thought, you know what, this guy knows how to time the stock of Glencore, if anyone does.
And if you think about right now, I mean, look, one thing, and then I'll talk about that. It's underperformed the MSCI World Index since that IPO by 66%. I mean, to be a complete dog relative to the World Index, right? And then it's even worse versus the S&P. But does seem like, I think everyone respects Glencore, and almost all these companies we're talking about are pretty great companies. So you got to always remember, company and stock are not the same thing, right? Like, you got to think about that, because Glencore's just getting back above its IPO price when Rupert was selling this 15 years ago.
I know. Isn't it something? So the next one, which is a classic, is Rivian. And I've got a personal story here. I remember going to the Deutsche Bank auto conference in Detroit in early 2019. And I was, private company in China. And I was getting the occasional one-on-one with hedge funds that I'd never heard of, up in a converted bedroom in the MGM in Detroit. And RJ Scaringe, who was the CEO of Rivian, filled the ballroom at the MGM for his presentation. The guy was box office. He'd just raised private round funding from Amazon and from Ford, right? And he was. I mean, my chairman was giving me a really tough time, because at that point he wasn't even mass producing his trucks, right? And we were churning out 1,000 a week. It was quite extraordinary. But then, this I mean, I can't remember what the market cap was post pop, but it was something like $45 billion day one,
something like that.
I can't remember. Not important. It's worth a lot less now. I have friends.
Yeah, and so I guess the takeaway is this: it doesn't have to be because if you look at our report, Rupert, go back to the summary page that I have that I put that from the report I wrote right before the Bitcoin IPO, and I just want to talk about that for 1 second, then we'll close the show out because we're running up against it.
I've got one final point to make, which is a gem.
But you can find this in it's underneath the paywall in the report Rupert and I authored, and I also I updated something that I did in January 24. But Meta ended up being a great, buying that IPO was a great investment. Visa also, but almost all of them, when you look at the opening price to the 1 year return, the average return is negative 24%. The median's negative 27%, and your win rate on those, so if you buy the open, is 19%. You had Snowflake, Airbnb, and then Aramco was up 1%. So you had 3 of 19 deals up on a 1 year basis, and only 6%, only one, which was Visa, was up more than the S&P in 1 year. So this is a pretty damning piece of historical empirical evidence that these IPOs come out at bad prices. Meta was down on its ass right away, ended up being a great stock. Visa got smushed, and to be fair, that was the GFC, so I don't want to attribute that all to Visa. But the point of the matter is the historical record tells you that mega IPOs are priced really well for the sellers, and the banks were taking a fee off the percentage of the money raised, and then not necessarily for you if you can't get access to the deal price. Deal price pop historically has been good on all these, but that first price, which most of you probably would, that's your chance to buy. You just got to be a little waiting, and like in the case of Rivian, there's a lot of these. Lyft, Rivian, Snapchat, they're all on that list. Those are all capital wipeouts, basically.
Yeah. So where's the trade here, right? So we talked about this a lot before we put the note out, right? The wise guy would go, all of the Elon fanboys are going to pile into that, but they're going to need to sell their Tesla in order to make room in their portfolios for SpaceX, which is the much truer Elon Musk property to own now. He's clearly lost interest in the cars. He likes his robots and he loves his rockets, right? And he loves his grok, right? So all of the fanboys are in the wrong vehicle right now if they're in Tesla, to forgive the pun. Now, I said I'm not going to fade Elon's ability to get the IPO done, but it, one, feels like a very long putt, and two, be very wary of all risk assets if this displacement effect is to happen. And then finally, I think that there's a plan B going on in the background, which is to, I know that there are governance issues. I know that there's antitrust stuff. There's all sorts of issues facing it. But ultimately, I think that a 5% probability that actually SpaceX gets reversed into Tesla is just the wrong price, right? And I think that, a little flutter on Polymarket could be a much better trade than shorting Tesla into the SpaceX IPO.
I like that. Yeah. I mean, I'm totally with you. I mean, and again, it's just a punt, but like my initial reaction to all this was, hey, I want to short Tesla. And I did a little bit with just a costless risk reversal, and we're up a little money on it. But, Rupert and I talked this weekend, and I'm kind of like, maybe he will just rope it in. Now, I don't know what price he ropes it in at. Maybe it has to get hit a little bit, and then he ropes it in cheaper, because why wouldn't you want to do that? But I don't know.
The task doesn't really get easier. Now, if you look in the model, you can play with the layout model, because I put an Excel in the note. You can murder my assumptions if you want. But even if you lower the price, right, he loses so much of the demand from that passive mugging, right? So he's kind of chasing his tail on price and deal size, right? So this feels like Mission Impossible to me, right? Not going to bet against him, but the merger looks like the easier trade, right? And then he never needs to make that $100 billion ask on the market. He just raises whatever he needs to raise to keep his rockets flying, right?
Yeah.
Anyway, I mean, we'll do a bit more on this point about, there was a really good reason why growth companies went public early in the old days, right? Because you were asking the market to make small but risky bets on growth companies. Now you're asking the market to completely displace risk assets in order to make a bet where, I hate the expression, most of the easy money's already been made.
Yeah, and so just think about it that simply. You want, we're a big fan of convexity on the show, right? You're like, hey, I want to layer in as much convexity into my portfolio as possible. Well, you used to, hey, it's an early stage growth company. It's basically a call option. And you're throwing call options in your portfolio, things that can make you 5, 10, 20 times your money or whatever. Now you're doing the exact opposite. It's much more like a bond where you have more downside than upside convexity, right? And that's just the way to think about it.
And for God's sake, do not watch the all-in pod about mining gold on the moon. For God's sake, stop drinking the Kool-Aid and sprinkling the pixie dust. This is everybody wants you to buy this deal, right? Because all of the insiders are in, literally every single one of them, and they're in at a microscopic basis.
Yeah, they want you to be bullish. They're all, think about it like this. You know, when they make a
The
movie,
all-in pod are all
sitting here in
in.
West Hollywood, you know, and let me tell you something. You make a movie and then you go put the stars on the circuit and they go pump it. They go in the talk shows, they go in the podcasts, and they're on E-entertainment, like just pushing it. That's what those guys are doing. And I would too if I was them. Just to be fair, if I had $1 billion or $100 million of stock, I would be out there on the circuit telling you that. But that would also mean that you wouldn't have to believe me. On this show, we're trying to give you real information because we don't have a stake in it, and we both have a long experience of dealing with IPOs, him selling, me buying, trading. This just doesn't smell good, basically, is my buyer beware, if you will.
So there you go. There's your weekly public service announcement from Benny and the Squirrel, and we're over time, so it'll be Benny and the Squirrel out. See
We're
you
out.
guys.